For the last couple of weeks, I haven't really been uploading a lot. I've been on holidays for a few weeks, so I was in Spain for a few weeks, and I'm also focusing on many other different things. For example, my Dutch YouTube channel, and also I'm running some master classes right now every single week to teach people how to lead a financially healthy life. So I'm focusing a little bit less on this channel. Well, as you might know, at the beginning of this year, I was doing 7 videos per week, so 1 video per day, but I'm now bringing it down to at least, 2 per week, probably, and maybe a little bit more, 3 per week. So what we're going to do today in this video is we're going to look at ChargePoint, because we haven't really looked at ChargePoint for a while, and I do think that there are some important updates. So we're going to do a so-called FUFITA analysis. We're going to look at the fundamentals, the financials, and the technical analysis for ChargePoint, FUFITA. So we're going to look at some things, for example, the earnings. We're also going to look at some companies that are being acquired by ChargePoint at this moment. We're going to look at those financials to see what kind of revenue, what kind of price to sales ratio, what kind of EV to sales ratio they currently have. And we're also going to take a look at the charts, so to do some technical analysis. So let's do it. Okay, so we're first going to dive into the earnings. First, we're going to take a look at the revenue they had for the second quarter of their fiscal year 2022. Might be a little bit confused by that, but it's the fiscal year 2022, not of course the actual calendar year 2022. So we're going to take a look at the revenue first of all, and during Q2 of this fiscal year of 2022, which of course is calendar year 2021, we see that they had a revenue amount of $56.1 million, which is a quite significant increase with regards to the last year. So last year they had $35 million in revenue. So that's an increase of 61% year over year. That's pretty impressive. And I was actually looking at the previous guidance for Q2 of this year, because during the Q1 results, they said, okay, for Q2, we expect to have results, revenue between $46 million and $51 million. So $56.1 million is like $5 million higher than the actual high end of their guidance for Q2, if that makes sense. Hopefully you're still following me. So that, in my opinion, is quite impressive for sure. We can also see, if we scroll down a little bit, that we have expected revenues for the Q3 of this year. So that is between 60 million and 65 million. That's for Q3 of this year, 2021, or fiscal year 2022. But for the full year, they have raised their guidance by 15%, I believe. From I believe the guidance was from 195 million to 205 million. So more or less like 200 million for the entire year. But it's actually in the presentation over here, so you can actually read it. 195 to 205 million for the entire year. But they now raised it to 205 to 235 million. So there's an average of 230 million. So basically, from an average full year perspective of 200 million to 230 million, that's a lot of numbers over there, an increase of 15%, which is quite significant in my opinion. So it's going to be very, very interesting to see if they're going to reach these numbers. I do think they are going to reach these numbers, and to see if they're actually maybe even going to exceed those numbers. So there's going to be very interesting to see what is going to happen during Q3 of this year and during Q4 of this year. And I actually want to go to the investor presentation for a second, because over here you can see the predicted revenue for, basically the next couple of years to come. This is the investor presentation, the latest investor presentation that is available on their website. And we can kind of see that, if you look at these numbers over here, right? 2021, this is this calendar year, basically the fiscal year of 2022. They were expecting a revenue amount of 198 million. So that's basically in the range of 200 million, the 200 million we were previously talking about. Now they are going to raise that to $230 million. So basically this number over here, 198 is going to be changed to $230 million. Now, if you look at the next year, so 2022, calendar year 2022, we can see they expect to have $346 million in revenue. So if you take into account that this year they are going to have more or less $230 million in revenue. Next year, $346 million in revenue. That is going to be an increase of 50%. And honestly, I do think that 50% is very much possible for ChargePoint, because if you go back to the results of Q2 of this year, we can see an increase year over year of 61%. So they already had 61% growth year over year. So I do believe that next year's revenue is definitely possible all, if it's, well, 50% revenue increase. So yeah, that's great. I can't even talk anymore. This is how impressive it is, in my opinion. I'll talk a little bit more about the negative points later on, but I do think this is very impressive what ChargePoint is showing right now, the way they are executing right now. And that leads me to this sheet over here that I have for myself, for all my stocks. So you can see basically the entire list of my stocks. Not all of these stocks are in here, but I'm kind of using this sheet to track the price to sales ratios of companies, to track the amount of cash they have, the enterprise values, the market caps, the EV to sales ratio, so the enterprise value to sales ratios. And yeah, one thing to be noticing over here is that currently ChargePoint has a price to sales ratio of more or less 29. If you look at their current market cap of $6.6 billion and the annual revenue for 2021, so the expected revenue, of course, for 2021 of $230 million. So that gives you a price to sales ratio of 29. Now, 29 is definitely not very cheap. I would say it's even a little bit on the high end. So you could make the case that ChargePoint right now is still a little bit overvalued, but do keep in mind that they are going to increase their revenue at a very rapid speed. If they're going to continue to increase their revenue by 50% year over year, that of course is going to provide a very nice result. Because if you look back at this presentation over here, you basically do see that they are at least trying to increase their revenue by 50% every single year up until 2026. They have and they expect to have more than $2 billion in revenue for the entire year. And with $2 billion, of course, the price to sales ratio becomes only like 3.3x. So that's quite a bit different from that number of 29. And also, if you look in at the results over here, you can see that currently they have $618.5 million in cash under a balance sheet. If you take into account the market cap of $6.6 billion, then the enterprise value is, well, basically the market cap minus the amount of cash is the enterprise value of $6 billion. So the enterprise value to sales ratio, basically taking the enterprise value and dividing it by the amount of sales they expect to have for this year, 2021, then the EV to sales ratio becomes 26. And also this is a little bit on the high end maybe, but again, if you keep in mind that they are going to increase their revenue by a lot, then this is not too bad, of course. Now, the thing is, there are some downsides to the Q2 results, and I am tracking this spreadsheet for ChargePoint. I do this for most of my stocks, actually, and you can see the results from Q4 of 2020, so basically last year, Q1 of 2021, and now these results of Q2 of 2021. And we're especially going to look at Q1 and Q2 to see basically the difference between these two quarters. Now, you can see, for example, that if you look at the total revenue for Q1 and Q2, there's a big increase of 38.5% in total. There's also a very big increase between the revenue for the networked charging systems. That was $26.8 million in Q1 and $40.8 million in Q2. So that's an increase quarter over quarter of 52.5%. Now, this looks pretty good, of course. 38.5% revenue increase quarter over quarter. That's pretty much insane, in my opinion. But also keep in mind that their expenses are going up quite rapidly as well. Their expenses have gone up quarter over quarter, 49.7%, almost 50% increase, which is way higher than the revenue increase quarter over quarter. So that's definitely a little bit annoying, and especially if you look at some of the things like network charging systems, 49% more. If you look at R&D, there's a massive increase of 59% quarter over quarter. Now, of course, I understand that they are trying to stay ahead of the competition. They, of course, need to do research and development to stay ahead of that competition, of course. But at some point, they need to become profitable, right? So, yeah, at some point, we do need to see a higher revenue increase instead of a higher expenses increase. So that is definitely a little bit annoying at this position. Of course, keep in mind that they do have a very nice cash position, so they can definitely take these hits. But again, at some point, they need to become profitable. So let's see when that is going to happen. And also, if you look at the G&A costs, so that this is general and administrative costs, that has also gone up quite a lot, 57% quarter over quarter. Now, I can imagine that there are some expenses related to the merger that has happened between between the SPAC, of course, and between ChargePoint. But I also imagine that there are some costs involved with the acquisitions that we are going to talk about right now. Because ChargePoint is definitely using that cash not only to grow organically, but also to grow by merging, or actually by acquiring other companies. In a previous video, we already talked about the acquisition of a European e-mobility technology provider, which was called Has2B, a very interesting name, by the way. And they were paying 250 million euros for this transaction, for this company. And right now we can see that if we go to this piece of news over here, they are also acquiring e-bus and commercial vehicle management provider ViriCiti. I'm not entirely sure if I'm pronouncing that right. Maybe it's a ViriCiti, but I suppose it's like ViriCiti to like look at the word veracity. Anyways, doesn't really matter. They are paying 75 million euros in cash right now. This is actually a Dutch company. I was looking at the company a little bit, but they are based partially in Amsterdam. They have a Dutch CEO as well. So this is a vehicle management system for electric buses and also for other commercial vehicles. And they are basically trying to integrate information sources to optimize electric fleet operations, including battery management, charging station monitoring, OEM agnostic telematics, vehicle maintenance, and vehicle operations data. So basically, again, a vehicle management system. Nothing more than that. And they currently have more than 50 employees, not only in the Netherlands, but also in the United States. So that is pretty good. So yeah, we can definitely see that ChargePoint is using their cash position to grow, to basically grow their dominance in Europe, because this is a very important market with regards to electric vehicles, of course, overall. We have been talking about that in many previous videos. They're also using cash to acquire more and more companies. And as we have seen in the results, they're also using their cash to invest a lot of money in research and development to stay ahead of the competition. And then let's do some very brief technical analysis, because we are looking at some very interesting support right now going on. We are trading around that level of $20 per share. And in the past, in the last couple of, well, basically half a year, yeah, half a year, like 6 months or so since March 2021, we have been using that level of $20 as support quite often. We can see a massive bounce over here on the 5th of March 2021. We saw a massive bounce over here at the end of March 2021, a massive bounce over here, April 2021, and a massive bounce over here, of course, in May 2021, which led us to this enormous move to the upside from basically this point to this point, which was more than 70%, quite insane. But right now we are back at those levels of $20 per share, so you could make the case that this could be an important moment, or a potentially a nice moment to buy or add a little bit to your position. Of course, that is not financial advice, because the thing is, we are still in a downtrend. We are still making lower highs and lower lows, so that is definitely not good. But however, if we look at the RSI on the other hand, we can see that the RSI is trying to go back to the upside. It is trying to stay above the EMA, so the RSI being this blue line over here, the exponential moving average being this white line over here. Usually it's a good sign when the blue line is above the white line, and especially when the white line is moving to the upside, which it is not doing right now. But we also see some more important signs like bullish divergence. Bullish divergence basically is meaning, whoops, that's not what I want to do. Bullish divergence means that the price action is making lower lows, whereas the indicator is making higher lows instead. So we can see that if we go to the price action, if we scroll in, we can see a lower low over here, a lower low, lower low, lower low. But if we go to the RSI, we can see that the RSI is trying to make higher lows instead. So a low over here, higher low, higher low, higher low, higher low. That is bullish divergence, which usually is a good sign. And also, if we look at the MACD for a second, we can see that the MACD, which is this blue line over here, is trying to stay above the signal line, which is the orange line over here. That is also a pretty good sign. And also here we see bullish divergence. If we look at the MACD histogram, so these vertical bars over here, those are, or that is the histogram of the MACD. And we can also see that we are experiencing higher lows over here. So we had a low over here, a higher low, and potentially a higher low that we are going to create in the next couple of trading days. So I definitely believe that there are some drives of bullish divergence on the RSI, on the MACD, which could potentially lead the stock higher in the next couple of weeks. So yes, ChargePoint is growing very nicely. They are investing a lot of money in acquiring companies, growing in Europe. They are spending money a lot on research and development, of course. And as we can see in the technical analysis right now is at a strong support around that level of $20 per share. However, if we look at the valuation of this company, we could make the case that ChargePoint is a little bit overvalued if we look at the price to sales ratio for 2021 alone. If we don't look at the future price to sales ratio of, for example, 2026, then we could make the case that ChargePoint is a little bit overvalued right now. Now, I want your opinion because I want to know from you, do you think right now is a good moment to buy, to add to your positions, or do you think it's a better moment to wait and see what is going to happen in the next couple of trading days, couple of trading weeks? Let me know in the comments. Now, if you haven't seen this video yet where I show my entire portfolio of more than $100,000, then definitely check it out to see how large my position is in ChargePoint right now. And if you have already seen that, check out my mission right over here, my mission statement and the roadmap that I'm going to use to achieve that mission in the long term. And with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye-bye!